What's up, guys? I hope you're having a good day. In today's video, I'm going to be reviewing SCHD versus VOO, or the S&P 500. So let's get right into this. First, I want to show you that I do own SCHD. I have $6,295.94. And then I also own 82.9 shares. And then I wanted to show you that I also own the S&P 500 index in my 401k, and I have $7,742.34 for 47.244 shares. Now, let's get right into this. So we have SCHD first. It's the Schwab Strategic Trust, or the Schwab US Dividend Equity ETF, currently trading at $75.94. It's down only 3.52% on the year, and it is on the upper bound of the 52-week range. However, I still think SCHD is a buy, and I'm going to show you why in just a minute. So we do have an expense ratio of 0.06%. Now, if we go over to the dividend, you can see it currently has a yield of 3.37%, which is a great yield for SCHD, and that's why I say it's a buy right now, even though it's close to its 52-week range. Anytime it's 3% or higher, I think you should just throw as much money as possible into SCHD. And we have a annual payout of $2.56, a 5-year growth rate, absolutely amazing, 13.74%. And it's been growing its dividend over the last 10 years, which makes it a dividend contender. Now, if we go over to the fact sheet, SCHD, their objective is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. So some highlights: it's a straightforward, low-cost fund offering potential tax efficiency, and the fund can serve as part of your core or complement in a diversified portfolio. And it tracks an index focused on quality and sustainability of dividends, and it invests in stocks selected for fundamental strength relative to their peers based on financial ratios. So let's scroll down to the holdings, and we have at number 1 Avgo, or Broadcom. Then we have Verizon, Merck, Texas Instruments, Home Depot, Cisco, BlackRock, IBM, Coca-Cola, and Pepsi, which are all great companies. Then we have their sectors. You have 21.14% in tech, 20.51% in financials, 14% in consumer staples, 12.48% in healthcare, 11.27% in industrials, and then so on. We have consumer discretionary, communication services, energy, materials, and utilities, which are not at high rate weightings. And so that is SCHD. Let's move on to VOO, or the Vanguard S&P 500 ETF, which is currently trading at $336.71. It is down 11.45% on the year, and it is just on the lower bound of the 52-week range. And we've got an expense ratio of 0.03%, which is half of SCHD's expense ratio. However, it's not that big of a deal, because when you're looking at expense ratios, a 1% expense ratio is $10 for every 1,000 invested. 0.1% would be $1 for every 1,000 invested. And then if you did 0.01%, that would be 10 cents for every 1,000 invested. So the S&P 500 is 30 cents for every 1,000, and then SCHD is 60 cents for every 1,000. Now, if we move on to the dividends, you can see they have a low yield at 1.64%. However, I would say the S&P 500, it's more of a growth ETF than a dividend-paying one. And then they do have an annual payout of $5.95. They have a 5-year growth rate that's actually pretty good, 6.37%. It's very close to 7%, which for me, I usually like dividend growth stocks to pay at least 7%, because that means your dividend is doubling every 10 years. Then it says they've been growing for 2 years. Now let's look at their fact sheet. So VOO, They seek to track the performance of the S&P 500 index. It is a large cap equity index. It's passively managed and it remains fully invested, and it has low expenses to minimize the net tracking error. So just about it, the S&P 500 index is a widely recognized benchmark of US stock market performance that is dominated by the stocks of large US companies, and the index includes 500 leading companies and leading industries of the US economy. Now let's scroll down to their holdings. So they do have 506 stocks, and their top holdings are Apple, Microsoft, Alphabet, Amazon, Berkshire Hathaway, United Health Group, Johnson & Johnson, ExxonMobil, JP Morgan and Chase, and then Nvidia. So this one is very tech heavy at 25.8%. Then you have healthcare at 15.8%, then financials at 11.6%, consumer discretionary at 9.8%, industrials at 8.7%, and then you have communication services, staples, energy, utilities, materials, and real estate. All right, now let's look at the most exciting part of this video, the portfolio backtest. So I have $1 million as the initial amount, and then we're doing 50-50 SCHD and VOO for portfolio 1, 100% SCHD for portfolio 2, and 100% portfolio 3 and VOO. So let's scroll down. And in the initial balance, so this started in 2012. And with the initial balance of 1 million, SCHD actually outperformed everybody with 4.03 million. Then we have the 50-50 split at 3.91 million. And then we have VOO, which performed the worst at 3.77 million. And then if we look at the best year, honestly, they're all about the same at 32%. But now what I want to look at is the worst year. So the S&P 500, it had the worst year at negative 18.19%. Then you have the 50-50 split at negative 10.71%. And SCHD's worst year was only down 5.56%. So now I want to look at this chart, the portfolio growth chart, just to show you guys something with these three different funds. So we have SCHD and VOO, the 50-50 in blue, SCHD is in red, and then VOO is orange. So I really want to start right here at about February to January 2028. As you can see right here, VOO is outperforming both SCHD and the 50-50 split. And so actually I want to go over here. So same thing, VOO is outperforming both SCHD funds. And even though SCHD overall outperformed the S&P 500 and the 50-50 split, I would still personally go for the 50-50 split of SCHD and VOO, just because I see the 50-50 split as SCHD is the defense and then VOO is the offense. Plus, it gives you insane diversity. With SCHD, you get those more solid, secure, blue chip dividend stocks. And with the S&P 500, you just get those, high growth, large cap tech stocks and other growth companies. And then if we go down here, you can see that actually during the pandemic drop, the VOO still outperformed both SCHD and the 50-50 split. However, what I like about the 50-50 split is that, as you can see here, VOO just on the run up during the bull market, VOO outperforms everybody. And so while the S&P 500 is on offense, SCHD is growing their dividend by that insane 13.74%, and they're paying that high dividend yield and just reinvesting back into itself. And that's while VOO is on offense. And then during the downturns, when during the bear markets when the S&P 500 is getting crushed, SCHD SCHD is playing defense, and they're funneling their income into those lower S&P 500 stocks so that when we get out of the bear market, VOO can go back on offense and continue to grow. So that's why I like the 50-50 split, because when VOO is on offense, SCHD is reinvesting into itself. And then during the bear markets, when SCHD is playing defense, SCHD is funneling that income into VOO so that it can shoot back up during the bull market. And even though SCHD has outperformed VOO in these last 10 years, that doesn't mean that SCHD is going to outperform VOO in every 10-year segment. And in fact, I do think that once the tech stocks rally, that VOO is just going to leave SCHD in the dust. But that's still fine because then SCHD would just keep reinvesting the income. Now I want to scroll over to the income. So you can see in 2012, the 50-50 split came in at $28,000. SCHD was the highest income at $31.2 thousand, and then VOO had the lowest at $24.8 thousand. However, they're all still relatively close. Then it's not really until 2019, 2020 when SCHD just starts blowing everybody away. And so in 2022, the 50-50 split was $100,000. SCHD was $133,000, and VOO just got blown out of the water at $63,000. So even looking at the income, you see SCHD outperformed everybody. I would still personally go with the 50-50 split because really, who's going to complain about $100,000 or six figures in passive income? I certainly wouldn't. And I would still like to see that price appreciation from VOO. And so, guys, thank you for watching the video. And if you would like to watch my major dividend stock portfolio update, just look at the video to the left and you guys can check that out.